Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to our special episode, London Eye, from London, where we are talking to a lot of investment managers who manage money in emerging markets across the world. I am veteran Sonja Laud, head of equities at Fidelity. Sonja, thank you very much for joining in.
My pleasure.
It's been a volatile start to 2018. Do you expect more by way of volatility?
The short answer is yes, but I think it's worth highlighting why we actually believe that volatility is here to stay. If you consider 2017, obviously has been an extraordinary year, not only because equity markets have had a very, very good run. It was very calm, very little volatility, but obviously the fundamental backdrop was very, very strong as well. And in the kind of jargon that we like to use, we call it Goldilocks, because it was very strong global growth, synchronized as such, and inflation has been very, very benign. Now, when we entered 2018, we still had a very strong backdrop in terms of the growth picture. But what we started to discuss is, whether inflation really could stay as benign as it has been all throughout 2017. And obviously, as it turned out at the end of January, it was the upside surprise print in the labor market data in the US that caused the initial kind of trigger for the first sell-off. Now, ever since, markets had to digest that actually some of the growth indicators seem to have softened, particularly in the developed world. And as such, obviously, there's a bit of a question mark, is that the start of the end of the cycle? Is that the start to a more severe slowdown? And as such, we have seen a lot of activity, a lot of noise. But if you look at year-to-date performance, actually, markets haven't really moved in any direction. The same applies to the bond market. And I think really this phase of reassessing whether this is now really the final part of the cycle, or whether we can assume that this is just a kind of a midterm pause, is something that will be here to stay, and to my mind will really kind of move markets. We might end up actually with very little real kind of movement in absolute terms, but there will be a lot of noise and volatility that accompanies this.
Well, you've sort of asked all the questions which I had for you in that opening summary, but which side are you on? I mean, are you more scared of inflation coming back and further powering on the bond yield beyond 3%, or are you in the camp which believes that growth will begin to slip off now?
I think we have to look at the more short-term and the longer-term picture, because short-term, clearly, I think we probably have had a bit of a too strong global growth backdrop, and it's particularly clear when you look at in some of the developed markets we're growing well above trend growth, which leads me to the longer term picture, because if we look realistically what the headwinds are, then obviously demographics, the debt overhang, and the lack of productivity growth are really formidable headwinds that will put a lid on global growth. And as such, you can consider that inflation is not very likely to overshoot either. And in that respect, it's very interesting that you mentioned the 10-year Treasury, because it obviously was at the center of attention over the past couple of weeks. It seems such a psychological market, and markets clearly paid a lot of attention on what's been going on there. But yet, if you consider what I've just said on the longer-term picture, it's clear that, yes, there will be volatility, but can we really see bond yields moving way beyond the current levels, given the headwinds we're facing? So I think actually that tactically, the fixed income space probably looks reasonably attractive right now, and I would consider that whatever's happening here is more volatility than really a fundamental move away from the levels we're seeing.
But would you go as far as to say that it's easier to see the yield back off to say 2.5%, or do you think the path to 3.5% is a path of easier resistance?
It seems that at least for now we have finally settled above the 3% hurdle, which, as you know, the first attempt failed. It was only really a one-day phenomenon, and then it moved back below. And so I think that might, to some extent, depend on the more short-term data, and whether there's any signs that either inflation or growth is moving in adverse direction. If not, then yeah, I mean there might be a few trading ranges, but then I would think that that the path towards 3.5 is not as clear cut. Although I would then probably assume that we stay at current levels most likely.
But even equity investors such as yourself, or equity specialists such as yourself, must be getting to that point where they start fretting about the inverted nature of the yield curve, because in the past it's been a telltale sign of some kind of a recessionary condition. Are we at that point where you start fretting about it?
So first of all, I agree with you that it has been a very strong sign in the past. I would question whether the signal is as strong as it used to be, just because we've still have had, or we're still experiencing very strong influence of a rather price-insensitive buyer in the form of central banks. We've had this influence over the past 10 years, and as such, although I don't want to take away of the nature of the signal, I'm wondering whether the strength is still the same today as it used to be when we had less of an kind of artificial influence on the kind of input factors. Because if you look at the other signals within the market, yes, they have been slowing to some extent, but not to an extent that would really point to an immediate correlation with the kind of flattening of the yield curve, although it's obviously true that it is very, very strong, and we definitely should not ignore it. But I would probably put it more in context with other signals this time round.
Since you mentioned the central bank, everybody dreams of a very smooth transition away from this tightening into a tightening phase. Do you think it will be as uneventful as equity markets believe, or a lot of equity participants hope for?
I would doubt that, just simply because we should be aware of the magnitude of the experiment that has unfolded over the past 10 years. And my fear is that we've kind of grown accustomed to the fact that they're just there and they're part of the day-to-day market activity. So taking them away, to my mind, naturally has to have some implication. The magnitude of these implications, I think we all don't know, and it obviously depends on how quickly they are implemented. But I cannot really subscribe to the idea that we've all signed up for the positive implication while they were there on the way in, i.e. providing all the liquidity to markets. And then I assume at the same time that if we take all this positive support away, that it does not have any consequences and will have a neutral impact on market. But to my mind, it's more about the awareness that this might not necessarily be a neutral market event, because for the time being, we don't know. The only thing we know is that from a communication standpoint, central banks clearly are very willing to be very, very cautious and tread very, very carefully.
Do you think markets were actually quite complacent about this, and maybe the realization is sunk in, which is why we are seeing this volatility of 2018?
Yeah, to some extent, although to my mind really it is the potential change in the fundamentals that has kind of led to the initial reaction function. And I think for most participants really the idea still is, okay, it's only the Fed so far that is raising rates, and let's face it, none of the central banks really has started to work on the balance sheet question, and it's the ECB that only just now tries to reduce the monthly purchasing program. So we're not really there yet that we could say that we are at a tightening phase, a proper tightening phase. Although to my mind, I agree with you, it's important enough that we stop the liquidity, i.e. we have this transition phase from quantitative easing towards quantitative tightening. And we clearly have to be aware on the potential implications. Because if you look at markets, market valuation levels, then clearly we as equity investors have benefited dramatically from the bond yields and the lower bond yields, because obviously, as we know, equity risk premia are related to the inverse, nature of the bond yield, and ever lower bond yields obviously had a very, very positive impact on the way we look at equities, and it had a very positive impact on multiples as well, because again we were willing to pay higher multiples for exactly the same earnings stream, just because obviously in the bond yield has had such a big impact on this.
Do you fear though that if we don't have such a very smooth transition, there might be a massive reset in asset prices as the world gets to live with much less liquidity?
It's a good question, because to my mind it will depend a lot whether this might coincide with a recession. Because let's face it, if the cycle were to come to an end, and we obviously could think hypothetically around a situation where a potential trade war between the US and China could accelerate the downturn, and as such then we would enter a recession with central banks literally still in very much an easing mode, and where to ease from there? Where's the support coming from other than yet more quantitative easing? And so that's an interesting kind of scenario where you then wonder whether asset prices probably would face, more of a one-off reset, which you wonder maybe it would be a healthy development, which at least would allow to come back to a much more normal price discovery mechanism that is less distorted, and we might find kind of more normal cross-asset correlation relationships that we were used to in the past.
What percentage probability would you assign to this outcome that you just mentioned?
That's a very good question. For the time being, it seems unlikely, and I think I probably can come up with a better probability post the midterm elections.
But not impossible?
No, not impossible, because I wouldn't rule out that a trade war is still, something that we have to consider. We should not forget the tactical element, because there is the midterm elections coming up in the United States, and I'm pretty sure President Trump is very well aware of the kind of headlines he would produce if he were to force China into kind of really stricter negotiations.
Yeah. Where does all this leave the US dollar? Because in the emerging market spectrum, everybody keeps his eye peeled on that. Of late, there has been a bit of strength. How would you map that going forward?
I think we have probably seen the bigger part of that move already, and you're quite right to point out that, particularly obviously from an emerging markets point of view, this is very, very important. And I thought actually it was very interesting to see that, although we have been arguing that emerging markets look a lot stronger if you look at the developments that have happened on the ground and you look at the fundamentals, yet again, when the dollar started rising, we have seen the first jitters emerging, particularly of the within the fixed income space and the local government bond space. And so, looking at all the moving parts, then it's clear that it was particularly the interest rate differential that has been the leading indicator for the dollar move. But if you map this against this, then it seems we have seen the majority of the positive dollar move already, and it's much more in line now with the interest rate differential that has led to it. And so it seems that from here, we have to wait and see what other data points we're getting. But the historic correlation between the interest rate differential still is the most important factor, and has been right again this time round that the dollar had to move to kind of catch up with this.
Earlier in the chat, you mentioned the possibility of the cycle coming to an end, and everybody stresses about that. Where are we in the cycle, do you think? I mean, do you think it's a matter of time before the cycle ends, or will this be a more elongated cycle? Any thoughts on that?
If you just were to look at fundamentals, then clearly you could see the cycle continuing for a while, easily up to 24 months or so. Because if you look at the data, there's nothing really that would worry us other than, obviously probably a bit of a normalization towards trend growth. So in terms of consumption, capex spending, this all kind of seems to kind of just trot along quite nicely. And hence it will come down, to my mind, to more kind of external factors that might add to an either deceleration or acceleration. Interestingly, there's two elements. One are the more negative ones around protectionism, potential trade war, which again, from looking at any historic precedent, it's clear that it is growth negative and could clearly add to an acceleration towards the end. Other areas that we're watching obviously are the credit cycle, and here particularly in China, because that we should not underestimate how strongly the China credit cycle has actually helped the global growth cycle. And clearly, if we look back to 2017 and the acceleration into the second half of 2017, then you find a very strong correlation with the credit stimulus provided by China. So this is an area we're looking for, because if you look at the global growth dynamic, then China is such a key part. So whatever the policymakers' next steps are in China will have an impact on the global growth dynamic. So that's literally the two areas we're watching very carefully.
But you speak of external triggers. I mean, what worries you most about where something might come out and blindside you? I mean, the trade war is off discussed. It's on the table now. Could it be something in the corporate bond market in the US if yields continue to rise? Could it be an accident in emerging markets like maybe a Turkey or something, defaults on debt? Where is it likely to come from?
You've raised two very important points already, and the corporate bond market, particularly the high yield space, obviously is priced to a default level that is not very realistic with the expectation for the end of the cycle. So you wonder whether we will see the kind of lead indicator coming from widening spreads, not necessarily across the board to start with, but within the pockets where obviously leverage has been rising the most, and as such we have the highest vulnerability towards higher interest rates and hence higher default rates. it is interesting because in aggregate it still seems okay in the US, but again, it probably the aggregate level is not really telling us where the pressure points and the stress points are. And again, it's something we're watching very carefully. So far, again, it's nothing that worries us dramatically. But again, you know, we know that back in 2007, 2008, it was the credit market that was the lead indicator of worse things to come. So we better have learned our lesson and pay attention to what's been happening there. The emerging market bond space is interesting, and obviously Argentina was the one that was in the spotlight more recently. And what I do find very interesting, and that comes back to the point around complacency. If you remember that it's not long ago that they issued their 100-year bond at yield levels that you know, we even back then wondered whether that really compensates for the risk you're taking, and yet just you know, a couple of months later, and the government has to call the IMF back in. So and it shows as well how fickle investor sentiment is, because obviously the sell-off we've seen in the currency and in the bonds has been quite dramatic. Whereas, you know, just a couple of months ago, it seems, you know, we were willing to pay quite healthy prices for a 100-year issuance for a country that has, you know, defaulted on a rather regular basis.
Having seen, I mean, I come back to that original question, having seen so many cycles over the years, what are your thoughts on being able to predict when the slowdown is coming or when the cycle is turning? Does it usually give you so much time and notice to be able to react? Or usually over the last few cycles, we've seen something external precipitating it and you have to react really quickly?
The difficulty again is that we're not quite sure yet where the potential turning point is coming from. And I think what we are trying to do really is just look at the risk framework on how to judge the macroeconomic environment. And the components clearly are that we try to really assess individually macroeconomic data. What's the growth and inflation outlook? Is there anything in the data that worries us that would be a lead indicator to think for things to come? Second is central bank policy liquidity. Again, obviously related to some extent to the earlier point. Is there anything in the data that would change the reaction by function of central banks that obviously then would have implication for markets? Then you add market valuation and sentiment levels. Whether you know, whether your starting point obviously provides you with some margin of safety or not. And clearly this is where some warning signals are, because most asset classes are priced to an extent that there is no margin of safety. And then you add obviously political events to it, because they are the most they're the most difficult to predict, yet can play quite a significant role to determine what then the market implication is of all of these. And for us, it's important to break those down into those four components, because only then you can detect where the sensitivities are, which obviously in combination will have the impact then on markets, on where we're heading. And, you know, warning signs, I think most of them we have highlighted already, what we're watching, and they can be either fundamental indicators or market-related indicators, as I said, within the fixed income market, you know, spread levels widening in some areas, you know, what's the read across. And I guess that really is the only way to be prepared then for potential changes. And as such, we try to apply this framework and be kind of humble enough to make sure that we can look at those data points on a regular basis to make sure that we're aware of any changes that is happening.
But speaking of the cycle, what about the emerging market cycle? Because that's not 8 or 9 years old. I mean, we've had a rough time.
Yeah.
So maybe we are 2 years into that cycle in emerging markets. How do you juxtapose the two? I mean, the developed market cycle versus the emerging market cycle that we're witnessing now?
You're absolutely right. The emerging markets obviously have taken longer to kind of see the recovery really starting across the board, and the adjustment processes did take longer than in the developed world. Yet again, looking at my risk framework, so I think I still can tick the box in terms of the fundamental data, because you're absolutely right that in terms of the growth momentum, emerging markets, particularly ex-China, still look pretty strong and still look to accelerate. Yet I cannot obviously ignore that there is an external influence, not only from central bank policy around the world, but in terms of market valuation and sentiment. And here I think I would include the dollar, because although this has no immediate influence on the fundamentals on the ground, it has an influence on markets. And hence for emerging markets, you always have to balance what's the strength of the fundamental data, and you know, might then even a sell-off, as we're experiencing right now, provide an opportunity to re-engage. So that really, again, same principles. Look at the risk framework, you know, assess them individually to make a case whether, you know, volatility and a market setback provides an opportunity, or whether it should worry us and we disengage. And I think very important for us here is you have to do this for each of the countries individually. They are no longer a very kind of homogeneous group that you should look at as one. You have to look at them individually, and I think the cases around Argentina and Turkey make this very clear, that what is going on there has nothing to do with the emerging market complex. It's a very kind of country by country case, and it's problems that are homemade from these two countries.
Where does India fit into that picture? As you say, I mean, look at it individually. What are your thoughts on where we stand?
India is interesting because obviously in terms of the growth profile, it definitely ticks the box and looks very positive. And again, obviously the oil price does play a big role for India and the stock market. And I think what we would say in general is that the current backdrop and the increased volatility is a backdrop for active stock selection. And if you look across our emerging market range, then clearly what you are finding is it's much more the stock-specific story that drives the selection rather than the country proposition. Yet we are obviously aware that if you have a country like Argentina, normally it does not pay off to engage even with individual stocks, because the country risk will outweigh the stock-specific opportunities. But for India in particular, it really comes down to the stock-specific areas, and it seems that from a growth angle here, the support of the two components is very attractive.
Sonja, it's been a pleasure. Thank you very much for your time today.
My pleasure.